All right, so we're going to go ahead and get started. This is a tough topic to talk about. The invasion of the Ukraine brings, so many of us. We have so many different thoughts, feelings about that, and I know I myself have frustration, anger, concerns, heartbreak, and I'm sure you're grappling with all of those. As the founder of Francis Financial and Savvy Ladies, my life's mission is to really help individuals put themselves on a path to financial security. And one of the most important ways that you can do that is by investing in the market and have your money grow for you over time. And that's what we're going to be talking about today. I just spoke a lot about the concerns, the frustrations, the heartbreak with the human tragedy, the upset to people's normal lives, the upset to people's livelihoods, and unfortunately, loss of life. So I do want to share that while we're going to be talking about the market today, we all realize that, losing a dollar here because of a wartime market drop um, is not the most concerning thing. Obviously, what's going on in the Ukraine is. But my hope for you today is to help inform you, because I also realize that there's understandably a lot of fear, a lot of concern about our own well-being, our own financial well-being, in addition to so many across the world. So we're going to go through this. We're going to spend about 35 minutes together, and our conversation today is going to focus on a update of where the markets are, what is being leveraged as far as different sanctions, how those sanctions are going to potentially impact Russia economically, politically, and how they're going to be impacting Europe and also here in the United States. So something that you may not know about me is that I have a real interest in this area. In addition to being a certified financial planner, my background in the early 90s was a political economics major in college. And so I remember studying this part of the world, and it was a very different part of the world than it is today. So much of what's going on and today in the market actually, comes in what happened and how the invasion of Ukraine came about isn't just something that happened overnight. This is something that has been building, and there are so many reasons that have happened really over the last couple decades. That's a little out of our conversation today, but if you want to talk more about that, trust me, I love to talk about this. And the next thing I'm going to do is I'm actually going to go ahead and share my screen and start to show you the presentation that we've put together. And again, we're focusing on what's going on. As you know, the invasion has really rolled the markets. People were on edge already. Concerns about interest rates increasing, concerns about high inflation that we've experienced over this last year and to continue to experience, and also concerns day to day of what's happening with sanctions, with peace talks, with negotiations. So the market has been one of the most volatile we've seen in years. And what does this mean? How has that actually played out? Well, we've seen that the S&P 500, so this is year to date. You can see that it's year to date down about 9%. This was as of just a couple days ago. However, if we look at the last 12 months, and that is February through February 2021, you can see that the S&P 500 actually still holds a really nice gain of over 16% that you can see here. How have foreign stocks done? Well, not nearly as well. Developed international stocks, they are actually down 12% so far this year, and they actually are still for the last 12 months. Emerging markets, that's China, that is Russia, although our exposure is less than 1%. And actually, even that has been jettisoned since this has all occurred. You can see that emerging markets are down so far year to date, a hard hit at 7%. And the last year, they've been, of all the different asset classes, the hardest hit of all of them. Now, what I have to tell you is that this has changed even over the last couple days. Over the last couple days, we've seen the markets rebound a little bit. In fact, for the week, the Dow Jones, the S&P 500 is actually flat. So you can see that it's a very, very, very fluid, changing market. So what are the best performers? What are the worst performers? Well, you can see that here. The best performers have been energy. And we're going to talk a little bit more about energy, why so many people are bullish on energy, what that means, and the what other industries have been doing well. Now, the industries that have been hardest hit, you can see, are consumer spending, worries about the average American pulling back on their spending. Also, concerns about having access to goods, access to raw materials, access to technology supplies to be able to continue to manufacture. Those are some of the concerns that, as well as many others, that have impacted these different categories. And so, what about the bonds? We just talked about stocks. What about bonds? Well, it's been an interesting story. There's been a huge reversal. Year to date, you can see that bonds were down. Both 10-year treasuries, which are pretty much the safest, what we call the safe bond, the flight to security, is you're seeing so much money going towards treasuries. You're also seeing US bonds doing very well as global bonds. But interestingly enough, year to date, they're still down. We expect that bonds will continue to do well. We're seeing what's called a flight to security. And what this flight to security, you may have heard of this before, but it's essentially individuals who are sitting on the sidelines who are moving money from either cash to bonds because they know that bonds are going to do well, or those that are fearful and are moving money from stocks into bonds. We know that bonds are the essential airbag of a portfolio. And guess what? So do investors like you. So that's part of the reason why you can see that bonds are doing so well and have gone up in value. This is good news for all of our clients. We are over allocated to high quality bonds. So while definitely the stock portion of their portfolio has gone down, this has been an area that truly has helped buoy and hold the value of that portfolio so that it's not dropping nearly as much as we're seeing in the Dow Jones, in the S&P 500. So one of the biggest questions people ask about is why not military action? And I'm going to be very honest and very authentic. Um, Words were said out of my mouth that I'm very glad are not public. Uh, I'm extremely angry and just really would love to show military might against Russia. That being said, I want to explain why military action particularly has not been on the table. The United States, Europe, Canada, Japan, other countries, what they've decided to do is impose unprecedented sanctions against Russia. There have never been sanctions this severe levied against such a large economy. What Biden has consistently said is that he has ruled out deployment of US troops. He will not risk US lives and has said over and over again, quote, let me say it again, our forces are not and will not be engaged in the conflict with Russia and Ukraine. There's a real concern that sending military forces will escalate the conflict, causing additional risk to the world balance of power, particularly because we are fighting with one of, if not the largest nuclear nation in the world. So instead, what countries are doing are imposing sanctions. And the first section of sanctions that they are imposing are finance oriented. The others are energy, technology, consumer. We'll talk more about that. But the goal here is to help raise the awareness to the Russian oligarchs people, the Russian common people, that what Putin is doing with their country is in the wrong direction. It was well known by the US, European allies, and others that sanctions were not going to put an immediate stop to the invasion that Russia is launching against Ukraine. That being said, though, it is making a difference. And the financial sanctions in particular are making a very big impact. Essentially, Russia has been handcuffed and having a much harder time reaching out to use its war chest. Essentially, their US and the allies have limited Russia's ability to transact business in both euros and dollars. Now, the Russian ruble, and we'll talk about this, the Russian ruble has drastically fallen in value. I won't say it's worthless, but what individuals are trying to do, governments, the Russian government tried to do, was to move dollars into quote unquote safer currencies. We've also seen this by those wealthiest Russians close to the Kremlin. We call them the oligarchs. Those individuals have been also stopped. They've been stopped, and we're seeing significant sanctions against them, their assets being frozen. We're also seeing that Russian banks are being hamstringed. Many of you have read about the SWIFT, what we call banking system. It's a system that is used to transfer money across the world smoothly. Now, it's what we're doing is essentially everybody's talking in English, and now we're forcing them to speak French, and they don't speak French. Now, they can get around it, but it makes it very hard. Without allowing the Russian banks to use the SWIFT technology to communicate, to move money effortlessly across borders, they are having to use secure emails, having other methods to be able to do this, making it wildly inefficient, making it very difficult, essentially hamstringing again the Russian banks. And actually, many of those banks' assets have been frozen into, as well as some of the wealthiest Russians out there. We've seen that the wealthiest Russians have lost not hundreds of thousands, not millions, but billions over these last 2 weeks since the engagement started. And if you can believe, even though it feels like years, it's only been 2 weeks since Russia started their aggressive attack at the Ukraine. So these are the financial sanctions that are being levied, sanctions that we've never seen before and starting to have an impact, essentially hurting the ability of Russia to pay its military and fund this war. Now, that's part of it, but there's another big impact, and it's in energy sanctions. Energy represents 2/3, 75% of Russia's exports to the world. Let me say that again. 2/3 of all their exports are energy related. And when it comes to their budget, their revenues, 50% of Russia's budget is funded by energy. So it's very understandable that this is one of the top topics, the most important topics that we have been speaking about, of how to really hit Russia below the belt and cause damage. So Nancy Pelosi came out and said just a few days ago that the chamber is exploring strong legislation to ban the import of Russian oil. I have to tell you, breaking news, this actually just was enacted. The US and the UK joined us and made an announcement that we will be banning not only Russian imported oil, but also Russian imported natural gas. So that will have an impact. However, the question that is yet to be seen is what will happen with Europe. Europe, as we know, has a much greater exposure to Russian oil and gas. In fact, it's it's quite significant. We're seeing that Anthony Bilkin went to Europe, is talks with the Western allies about this. There already is some action. We are seeing that that in particular Germany has made the announcement that they are not supporting what is happening. They are all looking at potentially banning Russian oil. However, it looks like it's not going to be economically feasible for Europe to put a 100% ban on both gas as well as oil. Now, this is something that we all need to watch, to stay tuned, and it's where we could have the most impact, really knocking Russia out at the knees when it comes to sanctions. However, the biggest concern is what this move would mean for Europe and the sky high price of what we know energy would go to. So how has this impacted the Russian economy so far? Well, the first piece is that we saw the ruble fall 30% in one day. We also have seen that the Russia central bank have increased interest rates from 9.5%, which as we know is pretty darn high, to a sky high 20% interest rates. And this is just to give you an idea. Right now, if you were to go get a mortgage, the interest rate that you would get now would be about 3.5%, give or take. In Russia, that's going to be about 20%. It's the same problem that businesses are going to have. These high interest rates essentially will strangle businesses who are unable to borrow. Not only are we seeing businesses really struggle in Russia from interest rates, we're also seeing high prices of inflation. Goods are not coming into, particularly technology goods, are not coming into Russia at the same pace. Factories are having to close because they don't have the raw goods, the materials to produce their goods and services. We're seeing companies like Starbucks, McDonald's, Apple, Netflix, and others pull out of Russia, shuttering all of their stores and franchises. It's all of these pieces put together that is creating the impact on the Russian economy, what it was meant to do, essentially to cripple the economy and make it known that the world does not support a country challenging and taking over a country, really going in the face of what our freedom is based on, as we know, democracy. So again, huge borrowing costs, crippling the economy. Russia is feeling this significantly. So now what about us? What has this done to the stock market? Well, you've seen it. You've seen it, and it probably has created a good amount of concern. There's been the flight from stocks to bonds. We talked about that before. We've seen the price of bonds fly up, just really grow in value as individuals are looking for security. They're looking for safety. A lot of people are keeping cash on the side, putting money to the side on a wait and see approach. But what we can all agree on as far as what is going to happen is that there will be continued volatility over the next several months. Now, what I have to share is that so much of what we're seeing and the sentiment and the fear, although a completely different circumstance, is something that we saw in March 2020. And I want you just to close your eyes and go back to March 2020. And for many of us, it's a very painful time. COVID was taking over the world. We were all in lockdown. We were no longer able to be at our jobs. Our children were being homeschooled. It was frightening, it was scary, and we were living through the beginnings of a pandemic. And we know what the market did. The S&P 500 dropped double digits in days. Individuals pulled their money out, concerned that it was the end of the stock market, that these companies could not survive in a pandemic when we were all locked in our homes. But I want to bring this back to you to live through what that turned out and the implications of that loss were. If you remember, by July, almost all of those losses were erased. We saw since July ongoing until the recent market volatility that we're experiencing a phenomenally robust bull market. And you have benefited from that. Anyone who stayed the course benefited from that. We're going to talk more about what those next moves need to be for you. But I have to encourage you to think again that selling now, even though we've had a great up day yesterday, is the wrong answer. For everyone, your portfolio is down, even if you have primarily bond exposure. Now is not the time to sell at a loss and put money to the side. Now is the time to make a commitment to your portfolio, stay with your portfolio, and when the dust settles, because this will be short-lived as far as in the market. I'm not saying that this conflict is short-lived. In fact, this will be the start of the Cold War that will go for many years beyond. Relations between the US and Russia have been severed. Relations between the US and the West have been severed. That is not going to be rectified in the next few months. But the market, once it had more information and had more clarity on what COVID was and what it would look like, that too will happen. And we will see that we will rebound from this. And let me tell you why. Because what we want to look at is what are the economic fundamentals? How is this going to impact growth? How is this going to impact GDP? Now, this is always moving. This is always changing. These are statistics and forecasts from a few days ago. But I have to tell you that the story is good. Market analysts still expect strong GDP growth for the United States. In fact, for the full year, They only revised downwards their overall expectation by less than a third of a percent. So they expect that overall GDP this year for the United States will be 3.2%, just a modest downturn from when the Ukraine-Russia conflict started. If you want to see in this chart, and actually this was put forward by the CNBC Rapid Growth Update, 12 top research analysts in the world, both micro and macroeconomic research, modeled out previous forecasts before Ukraine, Russia, and after. And what I have to show you, blue being previous forecasts, the orange being post Russia Ukraine conflict, you can see that overall, yes, in the second quarter, we expect GDP, we had expected 4.3%, a real strong recovery from COVID. Well, we see it come down to 3.5%. But overall, look at this by the fourth quarter, and this is why I said short-lived, potentially short-lived impact on our growth rates. The pre-Russia Ukraine forecast is nearly the same as the post. 2.65% GDP growth expected versus what we're looking at now of 2.5. Now, the other topic that we have all been talking about is inflation. In our financial plans, we use an inflation rate on consumer goods of 3.1%. For medical costs, we use 4.5%, for college 5 or even 6%, depending on the college we're looking at. But the inflation that we're living through today has flown through that multi-decade average of 3.1% that we use. In fact, right now we're seeing that that rate is much higher, and it's hitting us most at the pump. I don't know if you filled up your car with gas. I did. And the national average for a gallon of gas has reached $4 a gallon. We have not seen these rates since the crisis of 2008. And I will tell you, I remember as a little girl, my mom's job was to fill up the car, and I went into the convenience store and I got a gallon of gas. Sorry, I got a gallon of milk. The milk that I bought, mom would give me $1. And with tax, that dollar allowed me to get a gallon of milk. Well, you all know a gallon of milk has gone a lot higher. But at the time, the cost for a gallon of gas was $1 as well. This is where consumers are most concerned of how the restrictions that have been imposed, the sanctions on energy, are going to impact us. And it is going to impact us at the pump. This is one of the primary factors that's going to drive inflation. And let me show you a little bit more about what inflation is expected to look like. So right now, inflation at the end of the first quarter 2022 is expected to be almost 7%. Yeah, 7%. That's why it's been more expensive when you've gone grocery shopping. But forecasters predict that inflation, even with the impact of higher gas prices, energy prices, many other prices because of Ukraine-Russia conflict, will go down to a mere 3% by the end of 2022. They also state that while we talked about growth is not going to be significantly hampered by inflation. And I wanted to show this chart to you, again, by those same fantastic forecasters, researchers, economists. That 6.7% that we're seeing, expecting to hit that huge inflation number by the end of this quarter, you can see that that's going down to just 3% by the end of the year. So a healthy dropping. But I do want to alert you, and again, remember, pre-Ukraine-Russia conflict in blue, post-Russia-Ukraine conflict in orange. Inflation is not going away. We talked about the 6.7% this quarter. Well, Next quarter, it's going down, but not by a significant amount. Until the end of June, we're going to see higher prices. And it's not until later in the year, as we approach August, September, October, that we start to see these lower numbers of 3.9% inflation, and then ideally back to that 3%, a much healthier number for all of us and a lot easier on all of our checkbooks. So what does this mean? What does this mean for you? Overall, and I'm going to stop my screen. Overall, our clients' exposure to Russia is minuscule. It's less than 1%. It's very rare that you're going to see any investor have a significant stock ownership of Russian equities. You just typically don't see that. In the emerging market funds out there, if you own emerging market funds, that's where you find Russia. Russia is usually a very small subset of their holdings. The biggest holding, it's the big brother, it's China, which I have opinions about China as well, that you can give me a cocktail and I'll talk to you more freely about that. And even in the mutual funds that hold emerging markets, we're seeing numerous of them jettison any exposure whatsoever to Russia. So it's not the fact that the Russian stock market has nearly collapsed because of everything going on. What has impacted the S&P 500 and, well, also developed international, Russia, England, Germany, Spain, and the European friends is more so the knock-on effect on us. So I mentioned a few companies' names: Starbucks, McDonald's, Apple, Netflix, and many others that are pooling their operations or at least suspending them in Russia. That is creating concerns about earnings, that their earnings may be lower. And so that's having a knock-on effect on their stock prices. However you politically feel about that, or ethically or morally feel about whether what they're doing is right, it's still having that knock-on effect. There's also concerns about, as we talked about, inflation. And true, inflation is expected to spike and continue to be high over the next several months. But many forecasters, the majority of forecasters, are expecting it to come back to very healthy, reasonable levels of about 3%. The other concern that you're seeing in the stock market is concerns about GDP growth. US GDP growth is expected to still remain strong. The revisions downwards have been relatively modest. In Europe, the revisions downward have been, I'll be honest, more significant. We're going to see the developed international stock market hit much harder by this than us here at the United States. If Europe ends up sanctioning natural gas and oil from Russia, we will see that be even greater. So what does this mean for you? What should we do? Well, a few thoughts here. The biggest defense against this, the best way to insulate yourself, is having that well-diversified portfolio with mixture of stocks and bonds. Different industries, both growth stocks, value stocks, different size companies, both small, medium, as well as large, mega cap stocks like those in the S&P 500, as well as different countries. A diversified approach is never going to insulate you 100% from feeling losses in wartime market volatility that we are seeing. But what this opportunity is for you is to stay with your portfolio. And then when the dust settles, the market comes back, which we'll see in a few months, to have some really quiet reflection time about how the volatility you saw in your portfolio felt for you. And for some individuals, it's going to be a time when it makes sense for them to de-risk their portfolio, essentially a fancy way of saying adding more money to US stocks instead of emerging markets, adding more money from stocks towards high quality bonds that act more as a cushion, as an airbag to the portfolio. It's then that is the right time to decide how you want your portfolio to look like going forward. Because many people take on more risk than they really need. Many people's financial plan works beautifully with a 50% stock, 50% bond portfolio. And some people's portfolio can get them out to age 95 and beyond with even a 40% stock and 60% bond portfolio. Your financial plan that you have with us tells us that. So know that you don't have to feel that you have to be ultra aggressive. Now, I will tell you also, though, that being ultra aggressive, if you're behind in your financial plan, unfortunately, there's fewer options. It's one of the most important tools we have in our tool belt, in addition to your savings, to get you to age 65 to retire, maybe even earlier, and get you out to that age 95 and beyond. But know that if you have any questions, we are here for you. We are here for you, and we are with you every step of the way. We have so many Francis Financial clients here on the webinar today. Know that we want to talk to you. We are here for you, and you are not bothering us by reaching out. That's why we are here. And for those of you that are Francis Financial friends, maybe not clients, but dear friends, please reach out to us for a second opinion. If you're concerned, if you're nervous, if you're looking for any type of advice or help, we are here for you. So with that, I'd love to open this up to some questions. And I also want to tell you about a special gift that I have for all of you. We at Francis Financial are on top of everything that's going on in the market and the political economic world. You are the first to receive our white paper diving further into this topic that we're speaking about today, the Russia and Ukraine war, the market impacts and what that means for portfolios in the short term and the long term. All of you that are here today are going to receive a copy of that, and we'll be sending that out to you in the next day. Please feel free to also share this recording with anyone that is concerned about what's going on in the market, or just hoping to get a little bit more savvy of understanding what's going on in the amazing world that we live in. So I wanted to talk about this first question, a great question that came up by one of our participants here. And Jeannie Weber had mentioned, I'd planned to sell $40,000 in investments in mid-late April because she's building a new home. How do I sell now to avoid further losses? I can't ride the volatility out for this particular sale. Well, I have to tell you, it's not an easy thing to do to sell money, to sell a stock when it's down. Now, what Jeannie tells us is that she's in what's called a balanced fund. It's a mutual fund, and it has a mixture of stocks and bonds within it. So, Jeannie, you are up against a wall because you need this money to put towards building your home. And so I have two pieces of information that I think will make it helpful. Number one, the losses in the S&P 500 in the market, the stock market, are not your losses. You have a significant amount of money in that balance fund. I don't know the exact balance fund you are in because you didn't mention that, but most likely 30 to 40% is in bonds. Actually, have done very, very well during this time period. So know that you are going to see some losses, but not nearly as significant as you might fear. So my proposal would be to sell half now, especially because the market had a good up day. The second piece is to wait another 2 weeks and sell the balance. I can't guarantee that the market will be up from now, but I am very favorable that we will see some gains between now and then. Now, Sarah asked a great question. What adjustments have you made to your own personal accounts? Advice. What's the advice? I want to sit tight, but realistically, how long do I wait until I make changes if the market keeps falling? So Sarah, actually, I have made changes to my accounts that I'm happy to share with everyone. So I want to let you know that I'm probably invested more aggressively than most people here on this call. I know I'm invested more aggressively than any single one of our clients. I feel pretty darn young, at least I tell myself that. I'm 47. And so I don't expect to use this money for another 25 years or so. So I can afford to take risk. I can afford to see ups and downs in my portfolio because I can let it grow for me over the next several decades. But I did make a big change. So here at Francis Financial, we have an unbelievably robust 401k profit sharing plan, and we also have a defined benefit plan. Every year, I put money in to give to each one of my employees in each of these plans. Normally, we don't do this till the summer, but by Monday, we got that money in many months early so that number one, my employees and team could invest that money in a down market, moving from cash to equities and bonds. And I have to tell you, I did the exact same thing. Now, how has this turned out for us? Well, it's turned out pretty well. In fact, our defined benefit plan, which is a portfolio, a pool of money that is owned by myself as well as nearly every single person on the team, our accountant told us that we have to be careful that the amount of money we're going to be able to contribute going forward is most likely going to be reduced because over the last 5 years, it's grown so dramatically that we're now at running the risk of it being too large and being essentially out of compliance with the IRS. I don't know about you, but I feel like that's a great problem to have. Another question that many people have is, what can I do? What can I do? Not talking about your portfolio, but what can I do to help others during this time? The Red Cross is taking monetary donations, which they need most. They're also taking individual donations of goods and everything from clothing to diapers. So while we all feel, I at least personally feel a little helpless, know that it doesn't have to be that way, that you can make a difference. And part of that difference is helping others. So many of us are struggling, and you know my commitment to helping others. I founded Savvy Ladies, and we've worked with now 25,000 women. Well, I have to tell you that number is now 5,000 women coming to us each year. Many of them displaced from Afghanistan, and many of them eventually will be from Ukraine as they make their way over to the United States. So what I share to you is a warm hug to know you're not alone, to know that you can make a difference, and that we're here as your team to support you in any way with your financial planning, with your investment management. We're really here for you. So I want to say thank you to all of you for spending this time with me, for your trust, for your confidence, and most importantly, making my life so wonderful. I couldn't think of a better job to do. I come to work so happy with my beautiful coffee cup. And I don't know if you see this, it's a prescription for coffee. If you know me, that is my vice. So, anyways, thank you again for your time. We'll send you the recording of this, and you'll be one of the first to get the white paper talking specifically about these issues and more. Thank you for joining us today.